Now we're going to find out why gains and losses are removed from the first section of the statement of cash flows. Cash flows from operating activities. So on this statement of cash flows, notice we have a gain on getting rid of our plant assets. Getting rid of meaning disposal of our plant assets. Notice that they are subtracting the gain. So why is this happening? We'll find out on the next slide. We'll work through a transaction where we sell an item, an asset, and we have either a gain or loss. And then we'll see how it affects the statement of cash flows. Okay, on February 2nd, Mary's company sells a truck which costs $45,000 and has $5,000 of accumulated depreciation for $50,000. We're going to journalize the transaction. So here are the T accounts before the sale of the truck. So the truck costs us $45,000 and has $5,000 of accumulated depreciation. So what is the book value of the truck? What is the value of it on our books? So book value, remember, is the asset cost, $45,000, minus accumulated depreciation. So this truck has a value of $40,000 on our books. And if we're going to receive $50,000 for something that is worth $40,000, do we have a gain or a loss? Well, we've got a gain, a $10,000 gain. But let's take this one step at a time and journalize it. So we have to enter the date, February the 2nd. Now we received cash, $50,000. We'll put that in our T account, and then we're going to put it in our general journal. Cash is going to go up by $50,000. Now we have to get rid of the truck's accumulated depreciation. Since we're getting rid of the truck, we also have to get rid of its partner account accumulated depreciation. So how do we get rid of this account with $5,000 on the right side, on the credit side? Well, you have to debit it $5,000. So we will now debit in our journal entry the accumulated depreciation, $5,000. Now we have to get rid of the truck account since it's being sold. So we're going to credit it by $45,000. And we'll put that in the journal, $45,000 as a credit. Now, obviously, the transaction does not balance. But let's see if we can calculate the balancing amount and see which side it goes on. So we got $55,000 as a debit, $45,000 as a credit. That means we have a balancing amount of $10,000 that needs to go on the credit side. And earlier we said that was a gain. We know that because the truck was worth 45 minus 5, so $40,000 for the truck. We received $50,000 for the truck that was worth $40,000, so that is a gain. Another way you can tell that this is a gain is if the balancing amount is a credit, gains are like revenues. They have a normal balance of a credit. If it was a loss, it would be over here as a debit because losses have a normal balance of a debit just like expenses do. So remember, we're working on the statement of cash flows. So looking down here at this transaction, what is the cash amount? Well, the cash amount is $50,000. Which way did it flow? Well, our cash is increasing. And then, so which section does this $50,000 of cash go into? Well, we got the $50,000 because we sold a long-term asset, the truck. So that goes in the investing section. So the $50,000 goes in the investing section. Now remember, the $10,000 gain is included in net income. Remember, net income includes gains and losses. So gains and losses are embedded in net income. But we have to remove the $10,000 gain from net income because the cash flow amount was $50,000. If we kept the $10,000 gain inside of net income, we would be double counting the $10,000, which is actually part of the $50,000. So the next slide, we're going to look at the statement of cash flows again, and I'll show you exactly where the $50,000 increase in cash goes and where we remove this gain, $10,000 gain. So up here, we are removing the $10,000 gain because here's our net income. This net income includes $10,000 of gain. Well, we did not receive $10,000 of cash from that gain. We actually received $50,000. So the $50,000 goes down here in the investing section. Notice it says cash receipt. That's because we received the cash. And then we have to go back up here in the operating activity section, and we have to remove the gain. So how do we remove a gain? Well, a gain was added to net income, so you remove it by subtracting it. So in these slides, you will sometimes hear me refer to as backing out the gain or backing out the loss. So the lesson learned in here is that the gains and losses are not the actual dollar amount of cash flow. So we have to remove them from the net income because they are already included in net income. Then the actual cash amount, the $50,000, goes in the investing activity section because remember, sale or purchases of long-term assets goes in the investing activity section. And since we sold a plan asset, this $50,000 cash flow is going to go in the investing activities section.